This is Liberty Law Talk, part of Liberty Fund's online library of law and liberty. Your host is Liberty Fund Fellow Richard Reinsch. Our web address is libertylawsite.org, where you can subscribe, comment, find other episodes and links related to today's conversation. Our email address is lal@libertyfund.org. Today we are talking with Vern-McKinley about his book, Financing Failure, A Century of Bailouts. Vern-McKinley is a research fellow at the Independent Institute and has worked for the International Monetary Fund, Asian Development Bank, World Bank, U.S. Treasury, USAID, several accounting firms, as well as the law firm Morrison & Foerster. He has also worked in numerous areas, I think it's safe to say, of banking regulation at the Board of Governors of the Federal Reserve, the FDIC, the Resolution Trust Corporation, and the Office of Thrift Supervision. Vern, glad to have you.
Hi, good to be on. Thanks for the invitation.
Vern, the title of the book is instructive, A Century of Bailouts, and you argue that the bank bailouts in the fall of 2008, contrary to being unprecedented, stretch back policy-wise to the Great Depression and the process of actually bailing out banks in the 1930s. Walk us through the regulatory story, because it's one that I wasn't familiar with, and I think a lot of people aren't as well. That, contrary to what Hank Paulson and others were saying, this was something we had done time and time again for 80 years.
Yeah, I think you've hit on the individual, Secretary Paulson, who promulgated this whole idea that these were all new things that we were dealing with. And one of the initial quotes I have at the beginning of the book is from the Bible about there's nothing new under the sun, this whole repeating of history. And it actually goes back a little further than the Great Depression. Go back to World War I, there was a War Finance Corporation that provided bailouts for institutions that were having problems. At that time, there were these Liberty loans that were used to raise money for the government to pay for the war. It kind of squeezed out some of the banks, so that was kind of a very early case where weak institutions were bailed out by the federal government. And then obviously there was an explosion of it after that fact. That was during the Wilson days, and then in the Hoover days, as we got into the Depression, there was a Reconstruction Finance Corporation, which bailed out hundreds of institutions throughout the 1930s, and then after that, there was essentially a codification of it, a permanent codification of it. The authority to bail out institutions was given to the FDIC in the 1950s, and that kind of remained dormant for a while. But then again, in the 80s, the 80s, we saw some of the powers that were given to the FDIC used, and even in the 70s, there was a big institution in New York, Franklin National Bank, that was bailed out. You know, it's the same old story again and again. The arguments are that if these institutions fail, there's going to be all sorts of negative fallout, and we've got to put the money in and so-called stabilization of the system. And the most recent period also saw new legislation with kind of a twist. You had the TARP, which was one new piece of legislation to bail out broad-based across mostly. It ended up benefiting the big institutions. And then you also had Fannie Mae and Freddie Mac, who created a secondary market in the mortgage industry, and they come up in the news every week or two about their bailouts. So, I mean, it's really 100 years of bailouts, more so than Secretary Paulson implied that these are all new things. Maybe his knowledge of it was so limited that he thought it was a new thing. He doesn't have a real deep public policy background in finance. He obviously worked at Goldman, so he knew the private side, but he had very little understanding of the history of this, which is not unlike a lot of the other players, whether it's Secretary Geithner, who was head of the New York Fed at the time, or Chairman Sheila Bair at the FDIC, they really didn't have a sense of the history on it.
Let me ask you, and maybe this is an obvious question. When we say bailout, and thinking about this regulatory history, what precisely do we mean by bailout?
Well, I try to define it in the book. It's obviously either an intervention, meaning a loan or some kind of injection of capital, or it could be non-intervention in the sense that you have rules that the banks are supposed to follow and you give them forbearance, and that's another form of bailout. But it's some kind of intervention or inaction taken by the regulators, and they put funds at risk, and it's meant to be preemptive in the sense that instead of allowing the bank to fail, which, good old capitalism, I think it has a lot of positive things to say for it, just letting an institution fail and getting the managers out of there, the bad managers out of there, get the assets in the hands of entities that can manage better, that it's this preemptive action that doesn't allow the institution to fail. But for this bailout, you would have to go through receivership or bankruptcy or whatever the particular type of legal framework dictates. So it's really rejiggering all the rules that everybody thought applied, and kind of foregoing the obvious benefits of capitalism.
And so let me ask you an obvious question, try and make a distinction. So that would differ from lender of last resort financing that the Fed is authorized to engage in, because that would be to companies that are solvent but are facing a liquidity crunch at the time. Bailouts would go more towards companies or banks, financial institutions that are having huge capital crunches and really could not find access in the market to maintain themselves and are just really a sinking ship. Is that,
right,
is that accurate?
Yeah, the lender of last resort, it goes back centuries. Probably the most prominent of which is in the UK in the 1800s. They kind of made a fine art of it, and the idea is that in times of panic or strains in liquidity that are system-wide, what you should do is allow institutions to fail, but you don't want the illiquidity that's essentially caused by central banks in most cases. You don't want that to drag down institutions that are well managed. So the idea is you let big institutions that are poorly managed fail, but if you have a solvent institution that you lend on a temporary basis, it's well secured, and it's done at a penalty rate. These are kind of the characteristics that are applied not only in the U.S. but internationally, and there's no doubt about repayment. Whereas if you have an insolvent institution, the perfect example during the most recent crisis was Lehman Brothers, where it was pretty clear they were insolvent. That you don't lend to that type of entity, and AIG, in my opinion, was also in that category, but that was a case where the Fed decided to lend to AIG in any case.
A really interesting part of your book, you begin with the Bear Stearns bailout and the lead up of, we'll say, maybe a week prior to the decision where the Federal Reserve Bank of New York brings together J.P. Morgan to make a loan through the Fed to J.P. Morgan, then ultimately to Bear Stearns. And you describe that process of, there's a lot of back and forth, meeting by the minute, but you lay it out. You lay it out, the emails, the conference calls, all of the documentation behind sort of the decision and the realization, at least that the government actors believe supports the move they make. But talk about, because this is a part of your book, really, is you engage in an extensive legal process to get this information to actually learn the decisions made by the government. And I'm just interested about what you went through there and that legal process of trying to get the information to actually have accountable government, publicly release information about its actions.
Yeah, and that's I mean, it took me literally a couple of years to put this book together, and that was a big part of it. I mean, like everybody else in 2008, in the fall, everything was going haywire. I was looking upon it with the same horror everybody else was, and I mean, I've worked on these issues for probably 25, 30 years since I first started working. And so, I mean, I started to do some writing, doing some research, and I hadn't used previously what's called the Freedom of Information Act. I had heard about it. It's an act that supposedly allows you to get your hands on documents from the government, and of course they have some exemptions where they can say, well, this is something we don't want to release. And so I started under the Freedom of Information Act making some requests for some of the key documents. I started with the FDIC asking for meeting minutes and internal memos, and then moved on to the Fed and asked for a lot of the same information. And most of it came down to a simple question, which is, okay, if you didn't bail out these institutions, what bad things would have happened? And so from the FDIC, the initial response was that I received heavily redacted minutes, meaning they went through and whited out a lot of the details, maybe, 15-page document, 10 or 11 pages of it were whited out. So, and obviously the most important parts were the ones whited out. The Fed, on the other hand, completely ignored me. This is all late 2008 to early 2009, so eventually I had to bring suit in federal court. I got some help from Judicial Watch, which is a legal advocacy group, and ultimately ended up having 4 lawsuits starting in 2009. Some of them are still ongoing. Beyond the FDIC and the Fed, I also brought suit against the Federal Housing Finance Agency, which oversaw Fannie and Freddie and made the decision to put Fannie and Freddie in conservatorship. So it was quite a lengthy process. It was good to have Judicial Watch because they're familiar with that legal procedure. But after fighting a few years, I did get some pretty good information, a lot of internal emails from the Fed on, as you mentioned, the Bear Stearns situation. It showed that everything was pretty much seat of the pants. They
with the SEC actually certifying, what was it, a week before the decision was made that their books were that their capital was actually fine. They had sound capital. Is that? Am I remembering correctly?
The SEC went in early March. All this happened in mid-March as far as Bear Stearns imploding, and they went in a few weeks beforehand. And I don't remember if it was March or late February, but they looked at the liquidity situation, which was the key issue there, and essentially said, well, things are fine. We'll schedule further examination in late March, but their liquidity, they've got about $18 billion in liquid assets that is a good enough cushion, and we'll look at more detail at some point late March. But that examination never came because obviously they imploded in the middle of the month, about the 15th to the 18th, and so they were completely wrong on that front. And I mean, that's just one of many cases of that, where there was an examination or some kind of analysis that was done within a year or 6 months before. The other case of that was Federal Housing Finance Agency with Fannie and Freddie. They imploded in September, and as late as August, they were sending out letters to the management of Fannie Mae and Freddie Mac saying that their capital was just fine. And of course, a couple weeks later, they put them in conservatorship because it obviously wasn't the case that they were in a fine capital position.
So this kind of raises, and you've touched on it already, an idea in your book that you assert, which we could paraphrase maybe as "show me the evidence," and show me the evidence of impending doom, and in particular with regard to AIG, maybe as the most notorious. And I think we can all recall, the meeting with select members of Congress where Hank Paulson and Ben Bernanke went in and basically presented to them a horrific scenario, which they all came out and told us about, and this justified bailouts, and then further justified other bailouts. But you say there's really, that you could find, no real empirical evidence that regulators ever did to support these claims. It was just really kind of analyzing, and you say seat of the pants analysis, analyzing various lines of business, how large those were, and estimating the losses, thinking about the number of counterparties, how they would suffer, and just kind of assuming that things would go bad. You make what seems to me a rather obvious point of just how many of those counterparties, particularly with the AIG and the credit default swaps, had actually hedged against severe losses, so they actually wouldn't have even experienced the full trauma. So, I mean, talk about that exactly, the evidence you found of the regulators can actually produce this sort of doom scenario versus just asserting it.
Well, and before I get into the detail on the most recent crisis, this is another case of repeating of history. You have these what I call Chicken Little stories, where they talk about the sky is falling. If we let this institution fail, it goes back. I mean, you can go back 100 years to the Panic of 1907, which was one of the precursors and one of the reasons they created the Federal Reserve in the first place. There was a big institution called Knickerbocker Trust. The argument was you couldn't let it fail. Of course, they let it fail, and nothing too bad resulted from it. There was a short recession in the U.S., but nothing like the most recent crisis that we had. It happened in the 1930s. There was a big institution called Bank of the United States, and it was a New York institution. The state commissioner of New York said, if this fails, you'll have 20 institutions that'll fail in New York. And of course, they let it fail, and no other institutions failed. And somehow, with that evidence to the contrary, you'd think that the regulators would learn and wouldn't tell such stories. But you mentioned Continental Illinois. It happened in Continental Illinois. They said there would be 100 banks fail if there wasn't this bailout. And there was a congressional committee at that time that completely picked apart that story. There were flaws in the analysis, and it was just completely off base. So in the most recent crisis, that was a theme that ran throughout this, and a lot of the information that I tried to get through these lawsuits made that pretty clear. The first one being Bear Stearns. There really hasn't been any evidence released. Maybe there's some magic information in some of the information that was withheld that I didn't get my hands on, but as far as all the detail I looked on it related to Bear Stearns, there was really no evidence. They used the word contagion in their board meeting at the Fed, and there was really no evidence of contagion. This idea that if you let one institution fail, that it'll have a negative impact on others. And you mentioned the AIG and Lehman Brothers. Even though it didn't fail, there were a lot of arguments after the fact that Lehman Brothers, which was allowed to fail and go into bankruptcy, if you dig into some of the bankruptcy records of the creditors, even though a lot of people say that there was a lot of negative fallout from Lehman, really no substantial financial institutions failed as a result of Lehman. But a couple days later, they did bail out AIG, and we saw a lot of the same types of frantic and really scary type of language applied of all the things that would happen. And again, with AIG, no real evidence has been uncovered that there would be this domino effect, that we would have a collapse of the financial system. That's one of the favorite phrases used. Yeah. But I'm just really skeptical about that. I mean, even in my own work experience, I worked back in the 80s in Texas, and there was a very bad period in the mid to late 80s there. During that decade, from 1980 to 1990, At the beginning of the decade, you had the top 10 institutions. By the end of that decade, in 1990, of those 10 institutions, 9 of them were gone by the end of the decade. So I think that kind of puts to rest this idea that you can have a lot of churning in the banking system. Most of those failed outright. About 7 of them failed outright, and then 2 of them were taken over by out-of-state banking companies. So we can see, the last 15, 20 years that the Texas economy bounced back just fine, and I think a big part of it was the fact that we allowed these banks to fail, a lot of businesses to fail. The Texas economy moved away from a lot of its dependency on agriculture and also energy, and it diversified its economy. The new banking institutions came in, so I think it's a much better option to take to allow the institutions to fail. You get some new blood in the system, and if you compare the bounce back of Texas from the 1980s problems that they had, and you compare it with our own system today, it's a night and day difference. We've got a very pitiful recovery the last few years, and I think part of that is because a lot of the banks that did such a poor job are still out there. They have the same management teams, and it would have been a much better.
And the bad assets are still there, right?
Right, to a large extent. And, it would be a much better approach to just allow the system to cleanse out all the bad management, all the bad institutions, and allow new players to come in. Instead, you've got some of the same old players that are involved. They never lost their jobs. The people in the regulatory agencies didn't lose their jobs. In fact, most of them got promotions, or they went to the private sector and made 2 or 3 times the money that they're making. So everybody came out of that smelling pretty well, even though it's obvious that it wasn't good for the economy generally.
It's interesting on this point. You referenced Lehman. Of course, the standard narrative is that the failure to bail out Lehman provoked both was caused by the prior bailout of Bear Stearns. Lehman seems to think, and we know they weren't even prepared to file bankruptcy, that they were going to be bailed out, and so the failure to bail out Lehman somehow injected a tremendous uncertainty in the system. But yet you say, is an interesting argument, that this was actually good because actually what it proves is that when Lehman does go into bankruptcy, the chaos predicted doesn't necessarily result, and it seems to actually work for a lot of the creditors who aren't wiped out. And there is some sort of, contrary to a disorderly liquidation process, the bankruptcy process seemed to work and hold up fine.
Yeah, Lehman, it was handled by some experts in bankruptcy. It's a firm called Alvarez and Marsal. In general, I think they did a pretty good job of liquidating Lehman Brothers. It's still ongoing. I think the bulk of it is past us. But there were a lot of positive things that came out of Lehman. You got rid of this firm that was bordering on corrupt between their misreporting and the poor management of the institution. This is another case where Lehman actually almost failed during the 1990s, during the long-term capital management collapse, but somehow they made it through that, and then they continued on until the most recent period. And that's a good thing that cleansed an institution like Lehman, and it gave a lot of certainty as far as after the Lehman failure. People knew roughly what they were going to get as far as their if they had loaned money to Lehman. It gave a lot of certainty, and a lot of bad things did happen after Lehman Brothers, but there's no direct connection to me between the Lehman failure and all these bad things that happened. Maybe it made people wake up and finally decide, this is pretty serious, but that's nothing that you can really lay at the doorstep of Lehman. There was this one big fund, a mutual fund, that broke the buck, but if you look in more detail at what happened with that, they all the creditors for that fund got something along the lines of 96, 97 cents on the dollar. So I don't see that that was a big disaster. But this is something that's done internationally. Everybody talks when they analyze the European problems. They say we're trying to avoid a Lehman moment. But I think most of the people that use that kind of terminology really don't understand what place Lehman had in the whole crisis, and that there really was no connection between Lehman and all these bad things that happened. And again, I went into detail through the bankruptcy filing for Lehman and read through the various creditors, and there really wasn't that big a negative impact from that. And one thing that you distort or you that you don't want to continue doing in the case of Lehman is there were a number of creditors of Lehman that they went out and protected themselves by hedging, and what you had also with Lehman, there were a number of institutions that didn't protect themselves. So if you would have bailed out Lehman, what you would have done would have rewarded all these entities or investors that had gone ahead and didn't protect themselves either through hedging or otherwise. So it sends out the exact opposite signals of what you want in that case. You want people to lose money if they make bad decisions or they're not properly hedged, but a bailout completely distorts things and essentially rewards those that make the bad decisions, either not covering themselves through hedging or otherwise being prepared for those kind of losses.
So I suppose, I was thinking, if I remember correctly, you talking about AIG and also this concept of hedging, which wasn't really taken into account in the decision to bail out AIG. Because so many counterparties were going to be wiped out if they did not. And also you talk about with other banks that were bailed out, counterparties were funded 100% on the contracts, if I remember correctly. And Congress is even kind of plussed about that some. But I was thinking also the regulatory incentives are freakish. It seems with this process of the bailout. I mean, you kind of think it's a lot of money, but not an insane amount of money. I mean, certainly TARP was huge, is a lot of money, but and a large institution failing, the potential for a contagion. Why not just go ahead and do this? I mean, it seems to me that's just a very difficult problem to get around unless you eliminate it as a policy option, as something in the regulatory toolkit. Which, as you know, Congress seemed to want to do that in the 1980s after Continental Illinois, but federal agencies lobbied to keep it and won.
Right. I mean, you had these failures in the 80s. Continental was one. Franklin National Bank of New York. There was a First Pennsylvania, Philadelphia. You had the classic too big to fail institutions in the 1980s, and I mean, the normal response to that would have been, well, we should put limits on this. And if you look through the testimony, that was the general conclusion. And it was actually Democrats in the House that were pushing to get rid of this whole idea of bailouts, but it was mostly the regulatory agencies at the time and I believe it was the Bush Treasury, Bush 41, not Bush 43, that essentially argued, well, we have to have this last resort. We would only use it in the most rarest of circumstances, that we want to have this in, as you use the phrase, toolkit. And obviously we used it much more broadly based in the most recent crisis to cover just about the entire banking system when you get down to it. And then we saw again with the Dodd-Frank development, this whole idea that goes with it that, President Obama, when he had the signing statement for Dodd-Frank, said something to the effect of, this will put an end to taxpayer bailouts once and for all. So, I look at it a little differently. I think there's much more clear evidence that Dodd-Frank has kind of permanently codified a lot of these bailouts that were used in the most recent crisis. And I mean, this idea that we're going to put an end to bailouts is kind of a joke. And I really think that it's going to come down to, when we have the next crisis, it's going to come down to the people that are at Treasury, the people at FDIC, the people at the Federal Reserve, whether those people are familiar with the history and this repeating cycle of history, and hopefully they'll do the right thing, so to speak, and put these institutions out of their misery, rather than this whole cycle that we see where you prop up these institutions, you have much slower growth than you otherwise would have if you just allowed these institutions to fail, and you have legislation that's passed that supposedly deals with it. You had legislation in the 30s, you had legislation in the 90s, you had legislation with Dodd-Frank, but it usually is the case that the next financial crisis, the bailouts are even bigger, and the bailouts benefit, the whole. They're up to the point where they benefit the whole financial system. You had investment banks, you had the government-sponsored enterprises of Fannie and Freddie. You had big banks this time across the board that were benefited by the bailout. So it just is this repeating cycle where you say you're getting rid of bailouts, but in fact, the next time around, they even get bigger and bigger.
I want to ask you about Dodd-Frank in a minute, but I was curious, just thinking about the government-sponsored enterprises, Fannie Mae and Freddie Mac, where do they stand right now?
Well, they were bailed out coming up on 5 years. They were bailed out in September 2008. There were two options that the FHFA had on dealing with Fannie and Freddie. One of them was conservatorship, which is kind of essentially the government just takes over and continues to run the institution, doesn't do much in the way of downsizing. The other option is receivership, and receivership is where you actually downsize and liquidate the entity. And Secretary Paulson back in 2008 said, well, I really don't want to kick the can down the road. I want to deal with Fannie and Freddie, and I want to do something that'll allow us to unwind them as soon as possible. And of course, here we are 5 years later. Both Fannie and Freddie are still in conservatorship. They have, I've put in some FOIA requests over the last year or so that have revealed that they have looked at a receivership as an option, but I think we're looking still at 5 or 10 years down the road of Fannie and Freddie being in their same position that they are, which is, this kind of limbo position where they continue to operate just as they have been. They don't downsize very much, maybe a tiny bit, but they're essentially wards of the state, and there's no time that we can see in the immediate future where they're going to transition to the private sector, which is what they should have done a long time ago on it.
I wanted to ask you, just with Dodd-Frank, it seems, thinking about the century of bailouts, how could one not conclude, just thinking of the pieces that I've read on it, that it has not codified the bailout process, and even you can even see the ad hoc judgments are a part of the legislation, the unaccountability, the need for unaccountability if you're going to try and make it work, the secrecy that's a part of it. Even if you're a financial institution that is deemed a systemic risk, if I recall correctly, which would allow the federal government to intervene in your institution, for you to contest that is a secret proceeding. And as one, I think that jeopardizes you even further, if I remember correctly, in certain ways with the government to even contest it. Secretary of Treasury has extraordinary powers under the Act. It seems to me this is all just trying to make this process as rational as one could. And so it actually becomes a first resort process in a way, given also the regulatory incentives that, why not just make a move and try and save it and prevent the fear of contagion of financial shutdown, et cetera?
Well, I think with Dodd-Frank, it's pretty clear that the regulators and also most of the key members of Congress, whether it's Senator Dodd or Barney Frank or otherwise, they bought into this whole narrative. Whether there's a question of where it came from, but most of it came from these agencies. Number one, they said that all these bad things would happen if you did not bail out these institutions. The second point of it was that these interventions saved us from another Great Depression. And then the third idea is one we've already touched on, this whole sense that these challenges were unprecedented and that we had never seen it before. And I think there was a commission appointed to look at the crisis, the Financial Crisis Inquiry Commission, and you saw the split on that, where one group bought into this whole narrative. They were the majority, and for the most part, they agreed with these changes in Dodd-Frank, which were essentially superficial and are never really going to make a permanent change. And then you had people in the minority like Peter Wallison, who argued that the incentives that were put in place to push people into housing and push up the home ownership rate was a complete disaster. What you had, this home ownership rate was in the mid-60s for decades, from the late 60s to the late 80s and early 90s, and there was this big push into home ownership that pushed the home ownership rate from the mid-60s almost up to 70, and that was all government behind. I mean, if you look at the home ownership rate, there's this spike starting in the early 90s in the Clinton administration, and it really carried through the Bush administration. Bush 43 bragged on a number of occasions that he was helping to push up this home ownership rate. And if you look at that home ownership rate the last 4 or 5 years, it's come down to exactly where it was back in the early 1990s. It's back to about 65%. So if you think about the last 20 years or so, you had this amazing churning between pushing people into their homes, and then through foreclosure you push them out of their homes, and you end up back where you started from. Back in the early 90s, we were at about a 65% home ownership rate, and we're back where we were back then at about 65, 66%. So you think of all the angst that we put people through, put the economy through, all for this idea that everybody should be in a home that they own, and it should be financed by financial institutions in the system. And look where it got us.
I went in with a question that I think is, hovering over your book and the discussion. So is the solution one way? I mean, these large financial institutions themselves seem to be creatures of government regulatory power and intervention. I mean, is the solution to just basically break them up through taxing capital, or I don't know, various scenarios you can imagine, and just have smaller financial players? Would that be the way to deal with this going forward?
Well, as you say, there were a lot of incentives put in place to be too big to fail, and I think they really had their genesis in the 70s and 80s. This troika of institutions that I mentioned, Franklin National Bank, Continental, and First Pennsylvania, that kind of sent out the signal that it's a really good idea to get really big, because if you approach failure, you're going to get bailed out. But not only that this backstopping by the government is meaning you're going to have lower borrowing costs. So it really sent out that signal. What you saw in the 90s was
which is true in Dodd-Frank, right? I mean, that lower borrowing cost for those for large institutions continues.
Yeah, and it continues up to this day that these large institutions have that, and it can only be due to the fact that they have the government backstopping. But what you saw in the 90s was this enormous consolidation, and we had, to the point where, the top 5 or 6 institutions comprised 60-65% of the assets and deposits in the system. So it clearly had a genesis back in that period of time where they bailed out these institutions, and it got even worse in this most recent crisis. I mean, J.P. Morgan's much bigger than it was back in that period because it bought WAMU, Washington Mutual, and it also bought Bear Stearns, and Bank of America bought Merrill Lynch. So there's even bigger institutions. So, I mean, given the fact that these supervisors really dropped the ball during the most recent crisis, and didn't they essentially failed in their responsibility to be an early warning system and find these problems. I don't think the best thing to do is to give them more responsibility in the sense that they're supposed to take these institutions and break them up and get them down to some quote-unquote optimal size. I mean, I think that would be a terrible mistake. What they should have done, institutions like Citigroup, we should have let them fail and auctioned them off and broken them up as part of a market process of bank resolution through the FDIC or otherwise. I really think it would be a terrible idea for us to give the power to a bunch of bureaucrats in Washington to figure out what the optimal size of these institutions is. If they get near failure again, obviously I think we should just let them fail outright. But I think that would be a terrible mistake to give that power to these regulators that failed so badly. Give them the power to figure out what size these institutions should be through some kind of central planning mechanism.
And yet we have. So it seems as if so maybe we can end on gloom. The book we've been discussing is Financing Failure, A Century of Bailouts. We've been talking with the author, Vern-McKinley. Thank you. This is your host, Richard Reinsch, and you have been listening to a podcast that can be found at libertylawsite.org, where you can subscribe, comment, and find other episodes and links related to today's conversation. Our email address is lal@libertyfund.org.